Multiple choice questions on ratio analysis. First, which ratio shows the ability of business to pay short-term liabilities? So the answer is current ratio, as the formula of current ratio is current assets divided by current liabilities. This current ratio measures the ability of firm to meet short-term obligations, and the higher ratio means higher short-term solvency. Second, ideal current ratio for a business is usually considered as, so the ideal ratio is considered as 2 as to 1, as it is the conventional benchmark for a comfortable liquidity cushion, and it measures the enough working capital to handle the fluctuations in the business. Third, quick ratio excludes which of the following from the current assets, as the formula of quick ratio means acid test ratio is current assets minus inventories divided by current liabilities, as inventories are excluded, means stock is excluded, because inventory is the least liquid current asset and it may take time to convert into cash. Fourth, debt equity ratio measures. What debt equity ratio measures? As the formula of this ratio is total debt divided by shareholders equity, and it measures degree to which a company is financed by debt versus owner's fund, and higher ratio means higher financial risk, and that is why for the measurement of solvency debt equity ratio is used. Fifth, gross profit ratio is calculated on the basis of, so formula of gross profit ratio is gross profit divided by net sales into 100, and gross profit arises directly from the sales activity and gives correct relationship between sales and direct cost of goods sold, and that is why gross profit ratio is calculated on the basis of net sales. Sixth, a higher stock turnover ratio indicates, the formula of stock turnover ratio is cost of goods sold divided by average inventory into sales, and it measures how many times inventory is sold and replaced over a period, and that is why higher ratio means fast movement of stock, and in order to measure the fast movement of stock this ratio is calculated. Seventh question, which ratio measures efficiency of using fixed assets? So fixed assets turnover ratio is used to measure the efficiency, because this formula is used for measurement of efficiency of a firm which uses its fixed assets to generate sales. Eighth question, net profit ratio shows a relationship between net profit and dash. So the formula of net profit ratio is equal to net profit divided by net sales into 100, and it measures overall profitability from sales after deducting all costs and expenses, and that is why this ratio expresses the relationship between net profit and net sales. Ninth question is, a low quick ratio indicates, as the quick ratio indicates the company's liquidity and potential short-term liquidity stress, and that is why low quick ratio indicates that a company may not have enough liquid assets. and that is why option B, poor liquidity. Low quick ratio indicates poor liquidity. 10th question, working capital means. What is the meaning of working capital? As the formula of working capital is current assets minus current liabilities. As what is the meaning of working capital? Working capital means amount of short term funds available for day to day operations, and very high working capital means inefficient use of resources. Next question, return on investment measures. As the formula of ROI is net profit before interest and tax divided by capital employed into 100, and it measures overall efficiency in generating profit from total capital employed, and that is why profitability is the correct answer. Next one is operating ratio is equal to COGS plus operating expenses divided by dash. So the answer of this question is sale, because this ratio measures proportion of sales consumed by direct and operating cost. Lower operating ratio is equal to higher operating efficiency. Then the next question is, if current assets are 80,000 rupees and current liabilities are rupees 40,000, the current ratio is. So as we know, the formula of current ratio is current assets minus divided by current liabilities, and that is why 80,000 divided by 40,000 is equal to 2:1, and that is why the answer is C, 2:1. Next, which of the following is a profitability ratio? As the profitability ratio measures the ability to earn profit relative to sales, assets or capital, and that is why option B, net profit ratio, is the profitability ratio, as it directly links to net profit to sales. Next, high debt equity ratio means. What is the meaning of high debt equity ratio? So, high proportion of debt financing increases the fixed obligation and thus increasing financial risk, and that is why higher interest burden means lower net profit, and that is why higher debt equity ratio means higher financial risk. Next, proprietary ratio is equal to proprietor's fund divided by. So the formula of proprietary ratio is proprietor's fund divided by total assets. Why? Because it measures extent to which assets are financed by the owners, and higher ratio means higher assets financed by owners. Next question, which one is an activity ratio? So activity ratio measures how efficiently assets are used to generate sales, and stock turnover ratio evaluates inventory management efficiency, means how well inventory is transferred into the sales. 18th question, a decreasing gross profit ratio indicates. So the formula of gross profit ratio, we know that gross profit divided by sales. So if gross profit ratio falls, that increases relative cost, and that is why higher cost of goods sold is the correct answer. Then capital gearing ratio compares. So the capital gearing ratio compares fixed assets capital to equity, and that is why option A is the correct answer, as this ratio measures extent to which capital structure is loaded with fixed charge capital. And the last question is, a company with quick ratio 1:1 is considered. So quick ratio 1:1 means immediately liquid assets equal current liabilities, and this ratio considered satisfactory liquidity. So these are the 20 questions from the ratio analysis topic.